2018 is a tough act to follow as global growth spurred US equities to continued record highs. So it's no surprise that there was a surge in demand for equity ETFs. Now, as 2018 gets underway, let's take a look at some of the key market themes identified by BlackRock for the next 12 months. Let's also find out how to trade them. Joining me now is Karim Chedid, investment strategist for ETFs and index investments at BlackRock. Thanks so much for joining us today. I just want to start by picking up on some of your key investment themes for 2018. One of them was that the global expansion has more room to run. But if the US and Canada, Germany and the UK are all near full capacity, is the peak not months rather than years away?
So the global recovery has picked up pace, and while it's been nearly a decade that we've been in this recovery, we don't think that recoveries necessarily die of old age just because of the number of years that it's been happening. We look at the impulse behind growth, and that still looks quite positive across the countries that you mentioned, but also, importantly, at a global level. And the growth picture is looking more synchronized as well across these regions. While the countries that you mentioned may be reaching full capacity, other countries like Italy and Spain are still away from that full capacity, so they have room to catch up.
So do you still prefer equities to bonds?
Yes, so from a top-down cross-asset perspective, we prefer equities, and some of the reasons for that have to do with the cross-asset valuation picture. When looking at equity valuations in terms of earning yield versus bond yields, they still offer value.
So I wanted to ask you about the US tax cuts, because that's likely to be a key tailwind for US equities in 2018, but it could benefit some sectors more than others. What's your sector pick for this year?
So firstly, at a top level, the tax cut does bring the US to be a little bit more competitive relative to other players globally. It's just ahead of Germany, ahead of other countries. The UK still has a more attractive or more competitive tax rate for corporations. To answer your question around sector differentiation, it's very simple. The starting point is which sectors already had a low effective tax rate versus which sectors did not. Tech, for example, real estate, already have low effective tax rates in the US even before this tax cut, so they stand to benefit less.
So is tech less attractive to you in the year ahead?
So there are other reasons to like tech, such as the fact that tech companies are cash rich, they don't have a lot of leverage, so they do well when the Fed is hiking rates. But from the perspective of how much they benefit from the tax cut, they benefit less than sectors that are inward looking, like consumer staples, which benefit more.
So would you say it's better to be in maybe the banks if you want to play that lower tax theme?
Banks are definitely an area where they stand to benefit. They're inward looking, and their tax, the delta of tax change is quite big on them. So,
okay, if I move on to your second investment theme, that's the fact that you think that inflation is finally going to pick up. Why are you so sure that 2018 is the year that that does happen? Because we thought it was going to happen before. Many of these economies, like we mentioned, at full capacity, unemployment very low, labour markets are tight. Why this year?
Inflation lags growth. So prior to now, we were seeing growth really recover, and only in 2016 and 2017 did we see the expansion really pick up momentum and get more synchronized globally. Comes with a lag, so now is inflation.
But we have been seeing this debate about whether or not the Phillips curve is broken.
So we monitor inflation using in-house indicators like the BlackRock Inflation GPS, and this includes a combination of things, nowcasting data, which is the current economic data, but also social media feed. And that indicator has been pointing to some upside surprise for inflation readings. So that's one reason why we are positive looking at our in-house data. And then we're starting to see that breakout trend. The US CPI release last Friday was a beat, and Eurozone is still a bit behind, but the US is really starting to get to that point where we're starting to see some inflation pick up. The debate around the Phillips curve being broken is a good debate to have, and that's more about structural changes that have to do with technology and other disruptive forces. But there is a cyclical nature to this recovery, and that's starting to feed through to inflation.
I just want to ask you about the bond market, because some say we're approaching the end of the 30-year bull market for bonds. How high do yields have to go before we see a rotation out of equities?
So there's a couple of things here. The bond market is definitely facing some pressure. We started to see yields backing up, but in a very moderate fashion in the past month. We've been seeing the bond curve in the case of US Treasuries flatten, but it's been flattening for the reason that the front end of the curve has been repricing its expectations of Fed rate hikes. So even though some market participants may view the flattening as growth negative, we actually see it as growth positive.
Which is quite unusual because normally the flattening curve means that it's growth negative.
Exactly. But then more broadly, the bond market is facing some pressure from risks of quantitative tightening. So the Fed is looking to start shrinking its balance sheet. Those will be negative pressures, but we don't see it as a major meltdown.
If I just pick you up on the Fed there, because you said the Fed will be distancing itself from other central banks on monetary policy and rates this year, does that not spur the dollar to move higher? And in which case, is that a threat to EM and commodities?
So central bank divergence is a theme that we are looking at this year. The Fed is looking to hike potentially 3 or even 4 times in 2018. The market is only pricing in 2, so there's room for the market to adjust its expectations more hawkishly, whereas other central banks like the ECB and the Bank of Japan are still in accommodation. This does impact money markets, so it does, and it could lead to some appreciation and some upward pressure for the dollar. But we don't see it as necessarily as a big negative for emerging markets because the Fed is hiking for the right reasons. It's hiking due to good fundamentals, a high growth regime. A high growth regime is a good one for EM.
I want to pick you up on the ECB and the BOJ for a second there, because there's been a lot of speculation but no concrete evidence about when they'll begin to wind down their stimulus programs. Are you concerned that sharp moves in the currency market could impact equity returns?
So in terms of the yen, what's been interesting the past few weeks is despite the yen remaining fairly on the firm side, Japanese equities have been doing well. So
Nikkei 225 at a 26-year high, I think.
Yeah, so it's become a little bit more resilient to the yen. So the old rule that the yen has to drop for Japanese equities to do well has been broken in the past few weeks. So that's an interesting trend that I would keep a close eye on.
Is that because Japan is less dependent on exports?
It's probably more to do with the strong earning fundamentals and the view that the BOJ is in accommodation and some of the more fundamental pickup in the recovery there. Yeah, that's something I would keep a close eye on.
And just before we finish, I just want to ask you, what are the key risks around your investment outlook for 2018? Is it in the geopolitics? Is it in the politics? We've got a lot of elections coming up.
Mm-hmm. I think it's a combination of things. On the geopolitical front, we did start publishing as BlackRock a geopolitical risk indicator where we look at some of the risks out there and weight them based on how much they're being talked about in headlines. And that indicator has ticked up quite significantly over the past weeks. I'm sure you won't find that surprising, which means that there is a lot of geopolitical risk driving headlines. What's important, though, is to distinguish which of those risks have an impact on trade and on the macroeconomy. For me, one risk that I look at closely is US-China relations around trade. If those relations deteriorate, that could have an impact on trade and on the macroeconomy, and that's something that's worth analyzing.
And just finally, what's your biggest investment idea for 2018?
That would be emerging market equities. They did very well in 2017, outperformed developed markets. However, the outperformance cycle is not in months, it tends to be in years, and we think they could continue to do well in 2018.
Thank you. That was Karim Chedid from BlackRock talking us through his key themes and trades. That's it from me. I'm Victoria Scholar. And remember, you can always follow me on my brand new Twitter account at VictoriaS_IG.
Subscribe to IG for educational content, company insight, financial analysis, and expert commentary.